Hey everyone, and welcome back to Value Sense, the podcast where finance meets real talk. I'm so excited to dive into today's episode. We've got some juicy, and I mean juicy, market updates to explore.
I have to say, Ruby, you're setting the bar high with juicy. But yes, plenty to discuss today. From corporate shifts in chip manufacturing to pricing strategies from the likes of Nike, it's all about the balance between innovation and economic pressures.
Oh yeah, and let's not forget the wild ride some companies are taking. AI writing code, foldable phones, maybe even those stylish, but let's be honest, ridiculously pricey sneakers. It's all happening.
Right. And for anyone new here, this is Value Sense, a hedge fund quality analytics platform that, well, also happens to host this lovely podcast. We cut through the noise to deliver insights that matter for investors and, let's face it, the just plain curious.
Exactly. Insights with a touch of banter, wouldn't you say?
I suppose so. Shall we start peeling back the layers of today's market stories?
Oh, you bet. And it's a big one to kick off. NVIDIA teaming up with Navitas Semiconductor. This partnership is turning out to be a game changer. Think about it. NVIDIA and Navitas Semiconductor teaming up isn't just news. It's a strong statement about where the future of tech is heading. Two powerhouses in the chip industry joining forces. You know this is going to shake things up.
Indeed. Navitas specializes in gallium nitride technology, GaN if you will, which is far more efficient than conventional silicon in many applications. This partnership seems to signal NVIDIA's continued push to refine its edge in high-performance computing and power management. It's strategic, really.
Totally. And investors, they're probably looking at this thinking, wait a second, this could be kind of massive, right?
Massive, certainly. But it's also worth noting that the semiconductor space is increasingly competitive. This kind of alliance positions both companies to stay ahead of the curve, especially with demand for chips projected to surge in coming years.
True. But hang on, let's jump from innovation to, inflation. Nike hiking prices, it's got my attention, and my wallet crying a little bit.
Yes, Nike has announced increases of $5 to $10 across its footwear categories, with similar moves from companies like Subaru. It seems tariffs and rising production costs are making their presence felt in consumer markets.
Here's my question though. How do we not feel like totally rinsed as consumers? Everything just feels like it costs more every time you walk into a store or refresh a web page.
I think that's what many are grappling with. Inflationary pressures aren't new, but we're seeing a cascade effect. For businesses, maintaining a value proposition while offsetting increased costs is a fine balance.
Yeah, I get that. But Eric, you've mentioned before how a single price hike shifted your whole view on an investment, didn't you?
Yes. Years ago, I noticed an iconic brand suddenly raising its coffee prices one winter. It was a seemingly small adjustment, but it hinted at subtle cost pressures. That moment pushed me to reassess my portfolio and understand market dynamics more deeply. These incremental changes often signal bigger trends than they appear to.
See, that's it. It's not just sneakers and cars, it's everything tying back to these larger shifts.
Exactly, and these shifts are particularly challenging for lower income segments, who already struggle to keep up with rising costs.
All right, so speaking of these rising costs we just talked about, it feels like we're all under some version of a financial pressure cooker right now. Did you catch that stat about car loan delinquencies? Over 6.5% of people are more than 60 days late. That's massive.
It truly is. That's a record-breaking rate, and it points to a concerning trend. The lower income segment is bearing the brunt of it. These are families who, frankly, are just trying to stay afloat as costs across the board keep climbing.
It's not just numbers on a spreadsheet either. I mean, one of my friends was telling me how she's been struggling to make her car payments lately. She works full-time, the same hours she always has, but her grocery bill's up, rent's higher, and now she's like, how am I supposed to pay for my car too?
That's the reality for so many people right now. Rising costs on essentials leave less room for anything else, like car payments. And it's not just individuals. Let's not forget Klarna's latest report on credit losses. A $136 million rise year over year signals an underlying systemic issue.
Yeah, and Klarna kind of burst onto the scene as this buy now, pay later solution that was supposed to make things easier. But if people can't pay later, that just creates a whole new trouble zone, doesn't it?
Precisely. When defaults increase, it reflects a larger problem with debt sustainability across the economy. And then there's Moody's downgrade of US credit, an indicator that broader financial pressures could be creeping in, even at a macroeconomic level.
So we've got people feeling the squeeze, companies feeling the squeeze, and now the US credit system too? Is anything not under pressure here?
That's the million-dollar, or perhaps trillion-dollar question. Combined, these factors suggest we're in the midst of a complex cycle where consumer vulnerability plays a key role in shaping broader economic outcomes.
And when barriers like this pile up, it's like, who's supposed to shoulder it? Because it always feels like it rolls downhill to the average person.
You're spot on, Ruby. The real challenge is how long lower-income consumers can endure this financial strain, especially if systemic corrections don't come into play soon.
Exactly. It just feels like the gap keeps getting wider, between rising costs, economic headlines, and then just trying to live your life day to day. Considering everything we just talked about, the pressures people are feeling, it's kind of wild to think about how far tech has come, isn't it? AI writing code, foldable phones, and even smart glasses. Are we living in tech or sci-fi?
A bit of both, perhaps. Let's start with Microsoft. About 30% of their code is now AI written. That's a stark reminder of how quickly AI is not just supplementing, but transforming industries. It's a development investors can't ignore, that's for sure.
Yeah, no kidding. I mean, that's a third of their code. It's wild. And okay, Apple's next moves totally caught my eye too. A curved, mostly glass iPhone, foldable phones, that's next level stuff.
It is, and strategically on brand for Apple. They've always been about redefining product design and functionality. But the big question is whether this innovation translates into sustained growth, especially as competition heats up in the gadget market.
Fair point. And let's not forget Netflix, because those AI-generated ads, they've got people talking. Interrupting my binge with clever AI? I'm skeptical, but maybe that's their play to grab even more revenue.
Right. Netflix is navigating this cautiously, aiming to integrate these ads midstream and even during pauses. While polarizing, this move reflects broader industry shifts towards hyper-targeted digital advertising. It's innovative, but also risky for user experience.
For sure. And speaking of bold moves, RFK Jr.'s stock sales are like, what's the play here? Dumping Apple, Amazon, Nike, some of the biggest names out there?
It's an interesting one. Offloading major tech and consumer stocks signals that either he's restructuring his portfolio heavily or anticipating broader market shifts. Either way, it reshapes perceptions about where high-profile investors see value or risk in today's market.
Totally. And let's not forget OnlyFans. $8 billion? That's like, people are seriously valuing this as a major player in the digital economy.
It highlights the evolving definitions of value in tech and digital platforms. Companies that offer subscription-based niche content seem to be commanding impressive valuations. But much like the broader market, sentiment can shift quickly depending on performance.
Yeah, it's a reminder that in tech, there's always something groundbreaking and maybe a little eyebrow raising just around the corner.
Well said, Ruby. It's a constellation of innovation, valuation, and risk, all moving in dynamic ways, but that's what makes it exciting, right?
Exactly. And that's all we've got for today, folks. Thanks for tuning in to Value Sense, where we bring finance down to earth. Catch you next time.
Cheers, everyone. Stay curious and keep questioning the markets.